We'll cover some of the basic questions here, such as what does retirement mean to you? That is, what do you want or expect in retirement, whether you've already retired or not? Are there travel plans, hobby plans? Maybe it's volunteering your time or starting a new career or a side business. So you want to be careful with your expectations. The retirement income plan will be designed to support the retirement lifestyle that you envision. And then when do you plan to retire? That matters a lot if you're not already retired. Of course, once you retire, not common I see people unretire and then retire. But maybe when you plan to implement certain lifestyle changes in retirement can still require some retirement planning. And then how long? Well, that's a tough question. How long will it last, right? Unless it's a question of when you might unretire. In that case, that's some interim planning, but coming up with averages, we'll talk about that a little bit as well. Oops, did I jump ahead a little too early? Okay, here we go. So we can talk about early retirement considerations, and that can have an enormous impact on overall retirement income. So say early retirement, maybe before standard retirement age, typically that's around 65 or 67. If you're looking at Social Security, full retirement, or Medicare. But when you retire early, you're giving up what could be prime earning years. So those are the years when you could be making the most significant income in addition to your retirement savings. And the earlier you retire, the longer the period of time that your retirement assets may need to cover for your support. So there's a greater risk that you might outlive your money, especially if you're withdrawing a lot, and then there's also severe prolonged market declines that can have a big impact on the longevity of the portfolio. Also, there's an impact on Social Security. You can begin benefits as early as 62, but if you like to start receiving them at 62, your benefit may be as much as 25 to 30% less than if you waited for normal retirement age. 66, 67, most folks are now 67. We'll look at Social Security a little more later on. You're also not eligible for Medicare until you turn 65, unless you'll be eligible for retiree health benefits through your employer, or have coverage under a spouse's plan, or take another job that offers health benefits. You'll want to factor in the cost of paying for insurance or health care out of pocket, at least until you qualify for Medicare at age 65. And if you're fortunate enough to be covered by an employer pension plan, you'll want to check to make sure that it won't be negatively affected by your early retirement. The greatest accrual of benefits under a pension plan usually occur during your final years of employment, so it's possible that early retirement could effectively reduce this benefit you receive. And we'll look at that a little bit more later as well. And then there's delayed retirement considerations, which could add some certain advantages. Of course, the longer you work, the longer you'll be able to continue contributing to retirement savings instead of withdrawing, and that can have a quantum or compound impact. And even if you're no longer adding to your retirement savings, delaying retirement postpones the date that you'll need to start withdrawing from your savings, and a shorter distribution period could significantly enhance the potential to last throughout your lifetime. In addition, delaying retirement may return that you can delay taking Social Security retirement benefits, potentially increasing your annual benefit when you begin taking payments, because they do take the highest earning years, the highest 30, to calculate your benefit. And there's an impact on healthcare. Continued employment may give you continued access to more comprehensive or lower cost company-sponsored health insurance. And then if you plan to work during your retirement, that can have another significant impact. Obviously, the first advantage is that you'll be earning money and relying less on retirement savings, leaving more of your savings to potentially grow for the future and helping to stretch those savings. In addition, full or part-time work during retirement could potentially provide access to that affordable health care. And we're finding more and more employers are providing health benefits to even part-time employees. So I hear, for example, Starbucks does that. And so I've heard of some retirees, continuing to work, or early retirees just taking on part-time work at Starbucks to get the health benefits, maybe some free lattes, and some extra cash flow, of course. And there's just a significant, I think, physical and mental health benefit to doing some work. Doesn't always have to be paid work. There's very meaningful volunteer work you can do, but some form of work can have a very significant impact. If you do work during retirement, you'll want to make sure you understand how the income you earn might affect your Social Security benefits. While your earnings may increase your Social Security retirement benefit in future years, current benefits could be reduced. For example, for years before you reach full retirement age, $1 in Social Security retirement benefits will generally be withheld for every $2 you earn over the annual earnings limit, which in 2024 was $22,320. Special rules apply in the year that you reach full retirement age. That was for an individual, by the way. It's higher for married. It's worth noting that there are a number of non-financial reasons that motivate individuals to work in retirement. So again, that comes back to volunteer work, social interaction, sense of accomplishment, structure, whether it's volunteer or paid. And so basically that those non-tangible benefits, even launching a new career or starting your own business, can be very fulfilling. One last observation is if you're working for an employer that offers a traditional pension, determine whether working part-time will impact your benefits. If your benefit is based on your final average pay, it's possible that working part-time could reduce your benefits. It could also be worth inquiring about any phased retirement program that your employer might offer. These programs allow you to receive all or part of your pension benefit while you continue to work on a part-time basis. So sometimes they really want to hold on to your talent, the value you add, and they're willing to give you the pension even while you work, in addition to your earnings. So now on to that tougher question: how long will retirement last? So the good news is we're living longer lives, right? The bad news is that usually means a longer period of time that your income may need to stretch. And according to the National Center for Health Statistics, the average 65-year-old American can expect to live for another 18.4 years. So that's average for both genders, generally longer for women, a little bit shorter for men. The life expectancy has increased at a steady pace over the years and is expected to continue increasing. For many of us, it's not unreasonable to plan for retirement that lasts for 25 years or more. Those who do planning with me know that the standard default retirement age is 90. And sometimes we stretch that, sometimes we bring that in a little bit. And so, of course, the longer you plan to live, the more conservative your retirement projections will be. So health does factor in your genes, your family history, that can factor in. It's not the same answer for everybody.
Hey, Tim.
Yeah.
Can I just inject? I didn't see it in your earlier slides, but that doesn't mean it wasn't there.
Okay.
But one of the
What's that?
things that we've seen with family who are getting close to retirement is the impact of inflation.
Yeah.
And that's really caught some people by surprise. We're accustomed to low inflation. Social Security, of course, is protected against inflation, but most of us live off for our savings, and those are not inflation protected. So that is clearly a consideration that you have to throw in there. Anyway, I'm done. Thank you.
Very good point. Actually, there are some slides coming up that will address inflation. But to your point, it's been high lately. It was the highest it's been in a long time. We might revisit those highs depending on where tariffs go. So you got to factor that in. Absolutely, that can have a compound effect on the longevity of your assets to cover those higher expenses, and especially health expenses. They always have been higher, but they could be especially high, let alone other commodities and things that we rely on. So thanks for reminding us of that. Yeah, we'll spend some extra time on that. So every retirement income plan should strive to balance three main goals that should help to enhance your ability to enjoy your retirement. That means helping to make sure you have the financial ability to do the things that you want to do. Not everything requires a significant amount of money. Some do, and it's meaningful. You also want to manage the chance that you will outlive your money. Inflation could be a big factor on that. And also address the financial risk of unwelcome life events such as serious illness, the need for long-term care, or other anticipated expenditures for yourself or your family. And yeah, that long-term care can be a major impact to your finances. So we'll talk about that as well. So if we could put together a process for income planning, it's pretty straightforward, but it's good to review that. Once you know retirement will start, or when at least, when the type of retirement lifestyle you want, how long it may last, then you can start estimating the amount of money that you may need to make it all happen. First, you want to estimate your future retirement expenses to determine how much annual income you'll need during retirement. So factoring in the potential cost of healthcare and long-term care. And then consider the major factors that will affect your retirement income plan. For example, you'll need to adjust annual income estimate to account for inflation. You'll also want to understand the potential impact of taxes and investment risk. So then you total all fixed income sources you expect to receive, including Social Security and any employer pension plan that you may be able to count on. And when you compare your adjusted gross or adjusted income needs to your anticipated fixed income sources, you'll likely find that there isn't enough income to meet your needs and goals. So closing this difference or the gap is an important part of your retirement income plan. So to supplement your fixed income sources, you'll have to rely on your retirement savings. How you should go about this, including the products and the strategies that you may consider, depends on your current retirement assets, the amount of additional income you may need to generate, and the ability of you and your plan to tolerate risk, volatility. We've seen a lot of it recently. And as you've heard me say before, especially those my clients who do financial planning on a regular basis with me, they're the least likely to call me when there's volatility. Because we've looked at the bigger picture. We've looked at how we've already factored in volatility. It's to be expected. So it's good to have that to set you more at ease and know that investing in the market is not about timing it. It's about riding the waves better and knowing what your options are during volatility. So you can give time for the market to recover and be a more reliable long-term growth component of your income. And so how much income do you need? Well, you may hear that there are some rules of thumb, such as 60 to 90%, depending on who you're talking to, of your retirement income. But I also have a number of plans where it's 100% or more because of what they want to do. And that's okay. Everybody's different. So you want to be careful just using general rules of thumb. You also want to base an estimate, instead of it being on your annual income and a percentage of that, you want to focus on your actual expenses today and think about whether they'll stay the same, increase, decrease, or even disappear. Like a mortgage or cost for transportation to and from work. But other new expenses may arise, like yard care services, snow removal, or home maintenance. Things that maybe you do now, but they may not want to or be able to at a later age. And if travel or hobby activities are going to be a part of your retirement, you want to be sure to factor these costs into your retirement expenses. And while it may be painstaking, you want to try to detail every potential expense you can think of. That's hard. So sometimes to help people when they do planning with me, instead of trying to add up a list of expenses, because inevitably there's still a gap that we can't account for between their income, and then we subtract out all those and taxes and liabilities and savings, we still find that it's not balancing. So money is funny that way. It tends to find its way through cracks that we aren't thinking of. So that's a good way to start, is you just start with your income, and then whatever you can account for, you just have to assume it's being spent. So that can at times be a surprise to people, like, wow, I didn't think I spent that much. But that's critical if you want to continue your current lifestyle, that we potentially round up, even if it's a surprise to you, so that we're not underestimating expenses in the future and creating an overly optimistic picture, let alone underestimating inflation, right? So sometimes we'll bump up inflation assumptions to be more conservative for the future. Right now, the global average still is about 2.58%. But that's going over the past several decades. You average it all together. And it still is roughly a good average to use, but we're still kind of a bit above that, and it might go back up higher. So accounting for healthcare costs. Most Americans are automatically entitled to Medicare once they turn 65. And you have to make some elections, whether to purchase Part B or not. And you may want to consider joining a Medicare prescription plan offered in your area, or a private company or insurer that has been approved by Medicare. And then also, you have to know that it won't cover everything. So sometimes Medigap policies, which have a higher cost up front, but may save you a lot more because they can cover the gaps that Medicare with Part B does not cover, including copays, deductibles, and certain non-covered expenses that Medigap policies may pick up, or often do. So sometimes it's a question of, do you want to pay more up front and less later and have less risk of paying more later? Or are you comfortable with paying less now and taking a chance that your costs won't be significantly higher down the road? Everybody's a little bit different on what they prefer. Also, having the lower cost plans sometimes require you to stick to a certain network of doctors that might not fit your health needs. Having Medigap means you can work with any doctor that accepts Medicare. But still further, we're finding there are additional doctors that don't accept Medicare anymore. And that might be a growing problem too. Another reason to have some extra savings set aside for higher than expected healthcare expenses. And a reminder, Medicare does not pay for long-term care. That's a common misunderstanding. It will pay for some limited temporary care right after a hospital stay if needed for some temporary rehab. So that can sometimes be confused with long-term care, or include some long-term care services, but that has an end. And then once you're medically okay, that you don't need a doctor or nurse right by your side all the time, and you're just at home, but still need help with activities of daily living, that's the kind of thing that Medicare does not cover until you have spent down your assets or have a low enough income, and then maybe Medicaid kicks in. All right, but then your options for care are still quite limited. Nobody wants to get to that point, but it's important to remember that Medicare generally does not pay for long-term care. And so accounting for the cost of long-term care, just getting into some estimates here. Just a reminder again, what is it? And it could be related to a chronic health condition or a disability. Some things are treated by a doctor, but the custodial care at home, no. And so most individuals will need it at some point in their lives. Question is, how long and how expensive might it be? That's a tough one to grapple with. The national median cost of a nursing home is $116,000 per year. So we're talking almost $10,000 a month. In some states, it's significantly higher because, again, that's a median. Arizona tends to be above average. It's not the highest, though. And then Colorado, for that matter, probably a little bit higher than Arizona, especially more in the Denver area. And so if costs rise, oops, jumped ahead a little too fast. If they rise at a, say, 4% inflation rate every year, in 20 years, 1 year in a nursing home could cost almost $256,000. So that's where having a plan that can actually grow what you've set aside for long-term care could be critical. Or certain forms of insurance can do that too. So before we move on to talk about retirement income sources, let's just review some of the factors that can make retirement income so planning can be challenging. That's accounting for inflation, right? Recognizing the impact of taxes and potential risk, mainly in the markets. So here's a more specific inflation depiction. 3%, say, in 25 years, it will cost you over $100,000 to buy the same goods that cost $50,000 today. So more than double in a 25-year period. Not so good. You can see higher inflation, where some goods have already doubled over the last few years, right? I noticed that with chewing gum, for example. I'm a fan of peppermint extra gum. It used to cost $8 or less sometimes for a pack of 8. Now it costs $13 to $15. So I don't know what caused that, but you'll find some strange occurrences of inflation affect certain aspects of the different industries. Of course, eggs, that's another thing. That's more bird flu related, but inflation has also impacted that too with the distribution chain. So impact of taxes, ordinary income generally can be the highest tax rate, whereas special taxes for long-term capital gains and qualifying dividends can often be less, but it depends. Typically, though, 15% is capital gains rate. Ordinary income typically is 20% or more, but I have seen it sometimes flip depending on your situation and where most of your income is derived. There's also tax-free income, of course, the best kind, and certain tax advantage accounts. So having a good strategy that takes advantage of each can give you some flexibility and options if you're playing by the rules. So having a plan that when you are determining what your sources of income will be, understanding how each type of investment account or savings will be taxed can have a big impact on the order or which accounts you draw from. And then there's market risk, which we are experiencing more of lately, and reinvestment risk. So the chance that you may have to reinvest at a lower rate of return than the prior investment in order to get the same level of return. That's often associated with fixed interest savings instruments such as bonds or CDs. Bonds are under pressure lately with the dollar, with the tariffs being proposed. That could impact bonds, bond rates, and interest rates in general as demand for US dollars decline potentially. So there's a lot on the table right now that's being factored in and considered. There's interest rate risk. So when they rise, the price of certain investments will drop. Again, such as bonds. So current bonds, those values will drop if you're already in one because people can get better rates elsewhere. So it's harder for you to unload certain. Or rates, of course, can affect what you pay on any kind of borrowing. can make a lot of things in your lifestyle, even if you don't borrow, can still impact the cost of a number of things. So then we get into the old three-legged stool analogy. Traditionally, income has been described as that because it's composed of Social Security, pensions, and individual savings and investments. Well, the first two legs of the stool, Social Security and pensions, can produce a steady or relatively fixed stream of annual income that you can depend on during retirement. But most people, jumped ahead too quickly, aren't going to be able to rely on Social Security to provide for all of their income. And you may not even have an employer pension. So we might be just trying to balance on one leg. So that's where at least one other leg can help provide some stability. But we'll get to that. A little more on Social Security. So the vast majority of those over the age of 65 receive Social Security benefits or will. And the amount of Social Security retirement benefit you'll receive is based on the number of years that you've been working, the amount you've earned. And your benefit is calculated using a formula that takes into account your 35, I think I said 30 earlier, 35 is what I meant to say, highest earning years. The best way to know how much you can expect in benefits is by signing up for a My Social Security account. Or if you're already getting benefits, of course, you get your statements annually. You can also go on their website, but that's after you do some verification, identity verification things, you can view your own Social Security account and use a number of calculators and look at your own earnings record. Sometimes that can be helpful in case there's a mistake. And so the earliest you can begin to receive, as you probably know, is age 62. Oops. And if you decide to begin receiving benefits before normal retirement age, such as 66 or 67, anything earlier than that, then there may be a drawback because that benefit will be permanently reduced. And if you're at 62, like I mentioned earlier, the benefit could be up to 30% less than it would have been if you had waited until full retirement age. And of course, if you delay past full retirement age, you can get a much higher benefit if you wait all the way to age 70. So it all depends, though. Sometimes just having that income earlier is more valuable than waiting for a higher benefit. It depends on your personal situation, your health, and other cash flow needs. So it's not that it's bad. Also, if your health is such that you just you don't expect to live that long, then sometimes taking it sooner is better. And we mentioned how working in retirement can affect those earnings. So we want to keep that in mind. And the federal government periodically adjusts Social Security for inflation. So that's nice. Some pensions, most don't. But again, remember, it's only designed to provide some income. It wasn't ever meant to be a sole source of income. Pensions, if you are fortunate enough to have one, or if you know somebody that is entitled or may have one in the future, it's good to understand these things. If you haven't already selected a payment option, you'll want to carefully consider your choices because generally your retirement benefits are quoted at a single life annuity income. Typically, it's designed to start at 65, but you could start earlier at a lower amount. And if you're married, you should generally consider that your benefits be paid out on a qualified joint and survivor annuity, QJSA, approach so that it provides a monthly payment for as long as either you or your spouse is alive. But that does generally reduce the benefit compared to a single life annuity. And typically, though, your spouse's benefit is 50%, but you can get 100%. There's also a lump sum option, typically with pensions. You can roll it typically to an IRA and then invest it as you or maybe your financial advisor together see fit, or even create a private pension. In many cases, private pensions can be a better fit depending on what your goals are or if you're willing to take a little bit of risk in order to get a higher pension, that may be possible in a private approach. And so you really would just want to factor in that inflation, because not all pensions will inflate. So getting a private pension that does inflate or has the opportunity to grow with market growth might be in your best interest. But again, every situation is different, and it's good to test those out in your own financial plan. You definitely want to read the explanation of benefits, of course. Work with the HR people, work with somebody like me to review your options so that you know what is the best fit for you. And then if you remember, we talked about identifying the gap or mind the gap, like we're in the UK. Annual income needed in retirement minus annual income from Social Security equals the additional annual income needed, right? Or if you add a pension to add that in. So figuring out how to meet that gap usually comes down to that third leg of the stool, or second leg if you don't have a pension. That's going to be the personal retirement savings. So we're talking about IRAs, 401ks, maybe 403b or 457b, depending on what branch of government you worked in or in a public service job. So when it comes to putting together a plan to convert your personal savings into a source of retirement income, there are going to be some factors to consider, such as the asset allocation strategy. How should you invest? Should it be in stocks versus bonds or some blend of it? Should you factor in certain guarantees against market losses, which may mean limited upside growth, but once you're in retirement income and withdrawing, protecting against losses may be your best defense against early depletion. So finding the right fit for you and your tolerance for volatility. Working with a professional can help you narrow down options. Ideally, it's one who's an independent who can look at all, or if not all, many options, as opposed to just those offered by their employer if they're a captive advisor. So you also want to factor in your withdrawal rate. Rule of thumb 4% doesn't always work. What's the right rate for you? And order of withdrawals. Which ones and which types of investments? The sequence of returns can impact how quickly they deplete, meaning some years, if the markets are low or high, can have a big impact down the line on how long they last, especially if they're low early on. And then order withdrawals for tax savings can make a difference, depending on where you are with your total income tax. If there's a period in the future when you'll have lower taxable income, that might be a good time to take out the highest taxable accounts. Required minimum distributions also factor in. It's still your money. It's just the IRS requiring you to take it out. You don't have to spend it, but you can. But all we know is you're going to be taxed on it, whether you spend it or not. You could reinvest it into a taxable account going forward. So all these need to be factored in and considered for how to recreate that paycheck that can fill that gap. And so for personal savings, asset allocation, what does that mean? Transitioning from accumulation to distribution. So we've been growing and saving, maybe with the market or at least with interest rates. Now we're going to distribution, gradually pulling it out. And are we focused on immediate income versus long-term returns? If we need a lot of income or a significant amount, that can have a big impact on your investment strategy or how you're invested or how much risk you take. And then making sure that it fits for your needs. And when you're doing planning, you can often calculate the probabilities. That's something I spend a lot of time on. Where is the best probability for your unique situation? So traditional investing doesn't always work for everybody. Providing an ongoing income is number one, right? That income doesn't stop, even with market losses. But for those things that we need some market volatility to get the highest returns, but we're willing to take some risk, we still want to manage that volatility and ultimately enhance the likelihood that savings will not be depleted. So that's a balance between how much risk you take in investments versus what income you regularly get that's protected. And ultimately, got to keep pace with that inflation. All right, and then so to get more specific about the types of investments, bonds or bond funds can be helpful because they tend to have lower risk than stocks, have a stated return, but sometimes they're more sensitive to inflation and their value can decline. As we saw back in 2021, 2022, when we had the post-pandemic inflation that we're still dealing with to some extent, bonds definitely took a beating for a while. So there is risk there, even though generally they're less volatile than stocks and can be a good source of income from the dividends they pay and be relatively stable, but still using only those can present other risks. So having some diversification, maybe some dividend-paying stock can be a good fit for a retirement portfolio. Sometimes just having the highest earning stocks can be the best fit because over time they deliver the most total return, even though they might give you a lot of drama with the volatility. So that's not for everybody. And if you can get preferred dividends, those pay at a lower taxable rate, typically the same as capital gains rates, like 15%, maybe lower if your income is lower. But remember, we're talking about investments here that even bonds, yes, they have risk of loss. All right, and then we can also get into certificates of deposit, treasury inflation protected securities, retirement income mutual funds. These all can be suitable to some extent for protecting and delivering interest and dividends. And there's also annuities can be a fit to an extent to provide some more protection against market losses and provide ongoing income. But it's different from stocks and bonds. This is a contract, so you can rely on promises from an insurance company. You want to make sure it's a reasonably strong insurance company. They're not FDIC insured, but they also have higher reserve requirements than most banks. So it's all how you look at it. Still, there's always risk in every investment. But if you want some more certainties, some things that you can count on, annuities can offer that. Generally, you pay money into it or a premium. They promise to make payments for a fixed time or even for life. And that, of course, can be converted into income. Some of that income can be linked to market growth, or it can just be based on a fixed rate. But generally, across the board, most annuities will protect you against any loss, except for variable annuities. You can lose value, but some variable annuities still guarantee a certain percentage of income that can pay out for life. So ultimately, though, there are different costs and different risks with annuities. There are many makes and models, kind of like many makes and models of cars out there. Which one is right for you? An objective financial planner can help you with that. They're not intended to be a single solution. They're generally a way to complement, strengthen your overall portfolio, and in many cases, at least when I recommend them, they are shown to improve probabilities of not running out of assets prematurely. So more about that withdrawal rate before we wrap up. We want to make sure that we're comparing current versus future income needs and that the withdrawal rate is sustainable. So going from 4% to 5 or 6 or 7 might last for a while, but you got to be able to project into the future. There are calculation methods. There are a lot of calculators you can use now online. Just want to make sure you're using the right one and you're using it correctly. So while that 4% rate is normally a good starting point to consider, you want to find out really what is the right rate for you, especially in the early years of retirement, so you don't over-withdraw. And as I mentioned earlier, that order withdrawals can be a big factor for tax reasons primarily, and also for longevity with market volatility. There's also the income concerns versus estate planning concerns. And is it more important to you to leave a legacy versus maximize income, which could deplete your principal, but you might still have guaranteed income? You just want to make sure that your individual circumstances and your wishes for family are kept in mind. And of course, any investment you do that is using a retirement plan or IRA, you got to keep in mind that required distribution. Those rules, that you're meeting those, which generally just means you're taking out at least some income and getting it out of that tax shelter. And just before we fully wrap up, other sources of income might include your home. Some people say that's your largest portion of wealth. You want to be careful about how you go about that, but there are ways to still make the most of home equity and still be able to safely stay in your home. And using, if you have life insurance that maybe isn't as critical anymore, maybe there was a spouse and so you don't need it to protect that spouse. If it's a cash value policy, you might be able to tap into that, either for income stream or just lump sums. And also, as I mentioned earlier, a business, a side business, even a small one, even one you just do online, arts related, whatever, can make a significant boost to your income and factor into your overall income plan. So final recap here is, remember, when do you want to retire? How long should you plan for? Even if you're already retired, have you reconsidered that? How much income do you really need? What can you expect? And then how are your investments being managed to support your retirement income plan? A lot to think about.